Hi, I'm Pattu from freefincal. In this video, I want to talk about the handpicked list of mutual funds called PlumbLine for the quarter October to December 2023. I've been running this list from, I think, September 2017 onwards, and this is a handpicked list, so it is not going to be always quantitative, and these are my choices. And I think the way Indians invest in mutual funds has changed since the time I started. There are a lot of new players in the market, many young people are there, and they may not necessarily agree with these choices, but that's life. So starting with liquid funds, my picks are quantum liquid and parak liquid. Of course, you can safely take any established AMC and like ICICI, SBI, HDFC, etc., etc., and choose a liquid fund. Is not a big deal, especially after the spook in the debt fund industry because of the Franklin crisis. I think most mutual funds are playing it safe and want to invest in high quality debt, especially in the money market segment. So these are for a few months and above. I choose, I'm sorry, I use Quantum Liquid for emergencies, and also a small cash component in my retirement portfolio is there. For equity arbitrage, these are to be used for 1 year and above. They are complex products. They are being labeled now as liquid funds for high net worth individuals. That may be so, but you should still be aware of the kind of risks that these carry. They are no longer any pure arbitrage funds. They're all hybrid funds now. So up to 35% can be in bonds. And also many of these funds invest in within the bond category. They invest in other debt funds. So if there is a credit problem in the other debt fund, then your arbitrage fund will also get affected. I have selected ICICI arbitrage. There's nothing really special about this. I use it, so I'm comfortable with selecting it. ICICI arbitrage also is one of those AMCs that invest in another debt fund. If you look at it, I think it invests in ICICI savings fund, if I'm not wrong. Um, the returns in this category have come down significantly, probably because the arbitrage opportunities in the market have come down, because the markets have the amount of trading in the markets have increased, and therefore the price uh, misinformation, or I should say, what should I say, price imbalance between one segment and the other has significantly reduced. So you can't expect much returns by investing in these. Money market or ultra short term, I think a money market fund is good enough. In fact, this is one of the safest categories in all of debt funds. Most of the funds invest in very high quality debt, so you can use pretty much any established AMCs there. ICICI or HDFC money market is what I've recommended, but 1 year and above you can choose these. Gilt long term, this is for only for a long term part of a long term portfolio. Gilt funds from HDFC, ICICI, SBI are some things that I've studied in some detail, so I put them there. Of course, there could be other funds. It must be kept in mind that gilt funds are extremely risky. These normal gilt funds are essentially dynamic bond funds, so they will try to time the duration of the portfolio as per market conditions, etc. So they can get it wrong, so that can result in higher risk, etc. So I use ICICI Gilt Fund for both my son's education as well as my retirement. Conservative hybrid. So I've chose to invest in Parak conservative hybrid. A part of it, small part of it, is in my retirement portfolio, and a slightly bigger chunk is in my son's future portfolio. So this can invest in a good chunk in equity. If I'm 20 up to 25% is the maximum amount for these funds, I think, and a small amount in rates. So it can give you reasonably good returns, but it can also, the NAV can crash during market downturns. So you have to be careful for that. 10-year gilt. This is these funds invest such that the Macaulay duration of the portfolio is close to about 10 years, if my memory is correct. But these are very, very high risk funds. They don't do any kind of market timing, so they will always be invested in long term bonds. Unlike a gilt fund will can happily switch over to the short-term segment depending on market conditions, but these cannot do that. So these are only for those who can tolerate severe NAV fluctuations and understand portfolio management, rebalancing, etc. So this is not for everybody, but yeah. So I've recommended the ICICI and SBI constant maturity gilt funds. International equity, not a big fan of people who want to invest in international equity. They say they want to diversify, but most people they just see something shiny and they just want a slice of it. That's really not what diversification is about. Yeah, sure, it makes sense to invest in international equity if you know how to manage your portfolio. Today, you will say, I will hold 10% of NASDAQ 100 or 15% of S&P 500. But what will you do 6 months later, 5 years later, when those deviations are different? Will you rebalance and so, within the asset class and so on? So those are very complex questions. I think most investors are not capable of handling that. So I would prefer a very simple strategy where the taxation is like an Indian equity fund, and it invests in a small chunk of foreign equity, something like Parak FlexiCap. That's all I need, and I think that's fine. Of course, there are limitations about how much these funds can invest in equity and so on, but that's okay. I mean, I'm not going to worry too much about it. Like you're not. I mean, your fund will cannot determine how wealthy you're going to be. The amount you invest is what's going to determine how wealthy you're going to be. So I'm not too worried about all these things. So many people will disagree with me, but that's fine. Equity tax planning, there's no need for ELSS funds anymore. Choose the new tax regime and be done with it. Hybrid funds, equity oriented hybrid funds are some funds which are close to my heart. I use these funds in both my portfolios. I use HDFC hybrid equity and HDFC balanced advantage for both my goals. But I have chosen these funds with a consistent track record with respect to the CRISIL hybrid 65% equity, 35% debt index. So Canara, Robeco, ICICI, Mirae Asset, SBI, ICICI, HDFC. All these are hybrid equity funds. In addition, I've also recommended the ICICI multi-asset fund, which used to be called the ICICI dynamic fund. I invest in this as well. Flexi cap, large mid cap, multi cap. I think a flexi cap fund is what I would recommend. Maybe a large mid cap is also is fine. It's pretty much fine. A multi cap I'm not a big fan of because it has this segments of this much in minimum 25% in large cap, 20% small cap, 25% in mid cap. I think that's too risky. Many people know that I like Parak Flexi Cap. I have been a investor in this fund from its NFO stage. So one thing is that the fund has become very popular. It is probably the most popular direct plan mutual fund in the industry. It's got the highest direct plan AUM, and therefore you have to be careful, and because the past performance may not be repeated, and also it relies too much on the fund manager. I think the fund manager risk is very high in this fund. That's a risk. If you can take it, you can take it. Index funds, Nifty or Sensex, UTI Nifty, HDFC Sensex. I recently talked about. I didn't make a video on that, but I think I wrote about my son starting an SIP in HDFC Sensex fund. HDFC Nifty, whatever. You can choose anything. We have an index fund tracker. You can choose that. So, and also if you want to create an index blend, a large plus mid cap kind of blend, you can choose to invest in 20% of Nifty Next 50. Nifty Next 50 is a very tricky index. Has it become more of a large cap index than what it was earlier is a question that is I'm still studying that. There will be an article on this tomorrow. I think it's still emerging. Because the character of Nifty Next 50 is gradually changing. So I think it's becoming a less volatile and therefore less risky and therefore less rewarding kind of index fund. But I see no reason why I should discontinue recommending Nifty Next 50. So it's still there, and the video froze. Let me see if I can try and get it back. So yeah, so I see no reason why I should discontinue it. So it's still there. If you don't like 20% of Nifty Next 50 and you want less than that, then you can maybe choose a Nifty 100 index fund. There's one from Axis. I think other players have also come up with Nifty 100 index funds, but they are younger ones. I am invested in the UTI low volatility index, but I have not recommended it yet because it requires some time for me to watch it and so on. So, but I'm personally comfortable with its performance and I'm continuing to invest in it. And of course, there's no active large cap funds because very few manage to consistently beat the Nifty 100. I also don't want to recommend mid cap and small cap funds as well. Of course, we have our screener, and you can always choose that because small cap funds I've always been against. I think it's for personally, in my opinion, I think it's for young people. It's not for mature investors, in my opinion. They whatever they gain, they will lose all of it in the next bear run, and so it's just doing a blind SIP is a waste of money. Very few small cap funds manage to outperform the Nifty mid cap index or the Nifty Next 50. So there's no point for me to spend a lot of expense ratio on those small cap funds. So I'm not doing that. Even in mid cap category, very few mid cap funds have managed to outperform the Nifty mid cap 150. So that is a problem. So therefore, I'm not recommending any specific funds. I have some recommendations of what to do if you still want to invest in these funds, but that's something that you can read the article. The article is there in the community page. So that's about it. I'm sure many of you will disagree with this kind of fund selections, but I'm sure that's probably because you're younger than me. But that's fine. I think for me, when I invest in a equity fund or a equity stock, whatever it is, how much it gains in a bull market is not what bothers me too much. How much it loses in a bear market is what is more important for me. I want that downside protection. So I value that, and all my choices have always been based on that, whether it is a hybrid equity fund or Parak Flexi Cap, a quantum long-term equity, whatever I've chosen, and I still hold in these in my portfolio, have always been based on that. But that is my view of thinking. I fully appreciate if you do not agree with me. Bye bye.